Today is Wednesday, October 7th, and this is a market review for the stock market activities today. Here is the agenda of the day. And of course, we will discuss the market's bounce today due to the change of mind from the president's part regarding the stimulus deal and whether the bounce is legitimate or not. And here we go. The Dow Industrial Average closing in the green, big 530.78 points or a gain of 1.91%. The Nasdaq in the green, 210 points or 1.28%. S&P 500 in the green, 58.49 points or a gain of 1.74%. Here is the sector's performance. Everything is in the green, led by the gold medal for communication, or rather consumer cyclicals, followed by the silver medal for basic materials. And the bronze goes to technology. No losers today. Moving on to the futures market, leading the gains in softs, coca, cotton, coffee. Remember, we opened December contracts at the 107 price for coffee, and you see the trade working as expected so far. Sugar on a breakout, acting sweet for holders. Not so sweet are lumber and OJ. Lean hogs, nothing new here. The sky is the limit. And let's take a look at metals, and you see Mr. Copper leading the pack in the green, yet the rest of the metals futures are muted or red. Likewise, we've seen, of course, crude oil in the red today, so it is a little peculiar why copper decided to rally today. Perhaps it is a sign of the unsync in the market's bounce today, and it is indicative of a dead cat bounce. We'll see. What about grains? Mostly gains. Of course, grains, but notable, of course, are wheat futures. Wheat has been on a tear, and as you can see from the chart, since the beginning of the month, we've witnessed over 10% gains in wheat. Combine that with a gain in oats futures and dairy and the inflation in eggs prices, and breakfast will get very, very expensive. And here we go, visiting the big casino. What's going on the tables? What is the devil, aka SoftBank's Masa-san, is doing or not doing today? Apple leading the pack with about 1 million contracts traded today. Oh, about 71% of those were calls. Tesla, per usual, number 2, 743,000 contracts today. 63% of those were calls. Here is an interesting name at number 3, AT&T, old school, 355,000 contracts today, 84% of those were calls. Let's find out what's going on with AT&T by visiting the volume leaders. Right away, you see the gamblers are just rounding up the next number for Apple and Tesla per usual. They're buying the 115 expiring on Friday and the 340 in Tesla expiring Friday as well. But the notable action here is AT&T. They bought the 28 calls expiring next week. And here is the change in open interest, specifically the decrease in open interest. Which trades are being closed? Right away, my eyes are drawn to Peloton. They're closing the 115. Perhaps Peloton reached its limit here and it will witness declines from this point on. We've seen lots of closing in Peloton calls. Remember, last week we've seen the same thing with DraftKings. And I did buy puts on DraftKings right away. However, I was not aware of what's going on, and DraftKings actually rallied last week. However, this week, DraftKings declined significantly. You're seeing the effect of the action in the options market. Last week, taking effect in the shares of DraftKings this week. So sometimes you have to be patient. Give yourself a little time and give the trade a little more time to work. In this case, I am buying Peloton puts, and these of course expiring in November. And here we go, let's move to some interesting option trades we found out today. Number one at Kohl's, and that's with a K, the retailer. But they're buying calls on Kohl's, specifically the 22 strike price expiring next week. And we've seen Kohl's rallying about 5% today, along with all retailers and the apparel sector. We will talk about that in the heat map analysis. But of course, it is an interesting trade right here for Southwest Love. Not getting so much love from this particular trade, buying the 36.5 puts expiring next week. Somebody is not bullish that we will get a carve-out airlines stimulus deal. Moving on to the heat map analysis, and it is a sea of green with very few lagging exceptions. Notably, of course, Google and Facebook. These two names under scrutiny from Congress, and you see the shares reacting today. Here is some interesting action as well. You saw health care issuers rallying today along with pharmaceutical companies, perhaps under the assumption that the elections are determined and Joe Biden will be the next president of the United States. He's a big friend to health insurance companies and pharmaceutical companies. Of course, we know that the health insurance business in America is the biggest fraud ever. And of course, they love politicians who turn a blind eyes to their wrongdoing. And of course, we've seen interesting rise in tobacco and beer stocks the last 2 days. And furthermore, notable action today in apparel retailer, big gains today in auto parts stocks, big gains as well. Let's look under the hood for specific names in the rotation trade analysis. As you can see, the reopening stocks outperform the momentum / stay-at-home stocks today, although both did well. Of course, this is on the heels of the no deal on stimulus that turned into a potential maybe deal or half a deal, and we're playing the skewed game, wasting time back and forth, and the market liked the action today, so long as we don't have a stone cold no deal on stimulus. As long as they're talking, about debating, about thinking about a stimulus deal, that is good for the market. But I want you to pay attention to some boring names. Of course, all eyes are on the big tech names, the Apple, Teslas, Amazon, etc. But check out the silent rally in the comeback stocks. For example, General Motors, up 4% today, up massively this week and last week. So if you did take the Nikola dip and you bought GM, you are now rewarded. Take a look at another boring name, Cisco, in a silent mini rally of its own this week. Planet Fitness. Remember, a lot of the reopening names got hit hard a few weeks ago due to the resurgence of coronavirus in Europe. But Planet Fitness did not get hit at all. It is continuing to rally silently. How about Budweiser? Same story. Today and yesterday, rallying alone, quietly, not attracting any attention. TJ Maxx, check out the gains for the week. Unbelievable. Emerson Electric, again, massive gains, massive rebound from a couple of weeks ago. And that brings us to a very important point here. I do think in my long-term projection for the stock market and the economy from a macroeconomic level that we will see 70s like environment with a stagnant stock market, high inflation, high yields, very low dollar, and high unemployment. Meaning that the heydays of buying tech stocks randomly out of a hat and watching them grow 50, 60, 70, 100, 200, 300%, these days are over for two reasons. Number one, their valuations are stretched significantly and now they are entering the maturing stage. Meaning that if your argument for buying tech stocks is tech is the future, bro, maybe you need a time machine and you go 10, 15 years ago and buy tech stocks then, because the future is already here and these names are already pricing sometimes 10 to 20 years worth of gains and growth already. And of course, under 70s like environment of high yields, low dollar, high inflation, you will see that the money flow is shifting to big exporters and giant industrials, boring names like General Motors, like Emerson Electric, like Coca-Cola, like the defense contractors. These are the kind of names that will shine in the long term. The value names. Remember, after the dot-com bubble and the crash of the Nasdaq, value stocks outperformed technology for at least the next 10 years. And then we saw the second industrial revolution in the form of technology companies, whether it's social media or cloud or chips. However, I believe that this was the wonder of the 2010s, one of the best decades for investing ever. And as you know, easier markets are always followed by harsher ones. Enough said, let's move on to the headlines that shaped the day. Right away, of course, the markets were whipsawing all over the place. They dropped big yesterday, and overnight in the futures market, we saw a recovery. And of course, everything is revolving around the presidential tweets. We do know from this tweet that yesterday afternoon, the president decided to end stimulus talks with Nancy. And after the market crashed, we know how obsessed the president is with watching the market. It took about 7 hours and then he tweeted asking for an airlines bailout or stimulus specifically, aka a carve out for airlines and payroll because the money's already there. And then a few minutes later, he became more desperate and he was basically begging Nancy to come back to the table and at least pass the $1,200 stimulus. Because when you're sinking in the polls and your re-election prospects are pretty much in the toilet, your best hope is to bribe the population. And of course, we're not sure if the effects of the steroids are still there or not. However, insiders are now starting to question the president's mental health and the kind of risky behavior he's been engaged in since he was released from the hospital. We have no clue what he's gonna do or what he's going to tweet next. Read the markets. But we do know that he is now in a desperate and erratic fight or flight mode. A guaranteed recipe for volatility. And of course, here is Nancy. She had an interview today on The View. And she basically said that the president wants to pass the $1,200 stimulus so he can write his name on it, print his face, and pretty much tell America to vote for him, bribing the population. And the Democrats, per Nancy, saying no deal to that one. Matter of fact, the Democrats and Nancy have no incentive to do a deal right now. You have a president who is bleeding. They're smelling blood, sinking in the polls, swinging left and right, creating lots of destruction on his way out. Why would they do a stimulus and rescue him right now? Doesn't make sense at all. So the moron traders who saw all clear signal today and stampeded to buy the market might regret their decision very soon. Back to Nancy. She says that she has resumed the talks with Mnuchin. These are the talks about the talks, about the talks, about the talks of a stimulus. And of course, she says she is open to an airline carve-out, and she already presented this to Mnuchin before, and he rejected it. But perhaps now he will accept it, because Mnuchin, of course, is taking his orders from the president. Now, we do have a mixed picture here, because some White House aides came out and said they are not optimistic at all that a stimulus deal will happen before the elections. Here is my take. I don't think that there will be a stimulus deal before the election. I think that Nancy is playing Republicans like a bunch of donkeys. She's just putting the appearance that she is negotiating and she is serious about a deal, so she won, and her party, the Democrats, will not be blamed that Americans are not getting $1,200. But in essence, she is not interested in passing a deal right now. Why would she when the president is already on his knees? And of course, let's talk about the logistics here, whether we actually need a stimulus or not. Here is Morgan Stanley Mike Wilson, and this guy, of course, is glorified all over the financial news media as some guru and a psychic whose predictions are always right. And Wilson says that we don't need a stimulus for the economy to continue its recovery. Meaning, if we don't have a deal now, no biggie, we'll have another stimulus later on. And this is how the market is behaving so far. And we also had JP Morgan saying that the airlines, specifically United, are ample with cash. Remember, they've raised lots of money from the private market and treasury loans, and in addition to the first round of bailouts. Each airline is sitting on at least $10 billion worth of interest-free cash. Do they really need another round of bailouts? No, they don't. They will have to trim the fat in their business, lay off thousands of employees, and try to operate that way. No more bailouts for the airlines. They will use the bailouts, keep the jobs until the deadline, then fire the employees anyways and use the cash for buybacks or executive bonuses. The truth is the airline business right now need less employees, bailout or no bailout. And what about all the employees who will get fired from the airlines? Well, we're better off giving them the money directly via unemployment benefits rather than handing the cash to the airlines who will fire employees anyways. Now, let's look at the other side of the coin. We do have projections that a no stimulus deal will cost the GDP about 5 percentage points. Remember, every model for the GDP is accounting for a stimulus. Exception, of course, Jim Bullard of the St. Louis Fed. His projection exceeds 35% growth in the GDP in the third quarter with no stimulus. Now, what's going on with the unemployment picture? Here we go. Wells Fargo laying off over 700 jobs. So again, we can argue, do we need a stimulus? Do we not need a stimulus? I think we need a mini stimulus that goes to the people who need it the most. Poor people, people who are missing out on their rents and have outstanding bills, and they do need relief. What we don't need is hand out $1,200 checks to morons who don't need it, who are gonna spend it on buying calls on Robinhood or signing a lease on a car, buying iPhones. We don't need that. And the last bit of news we do have today, the Treasury Department starting forgiving some of the PPP stimulus loans they handed out earlier in the year. Now, we know that there was a lot of corruption in the PPP loans, and a bunch of millionaires and billionaires got free money because they're cronies with the administration. We also have some rich people who exploited the system. Some are famous, such as Tom Brady, who cashed in some cool free taxpayer money. And of course, so did Jim Cramer of CNBC, among many others. So is the Treasury gonna forgive these people for the loans? They're gone. They get to cash the money, even though they didn't need it in the first place? Yes, they do. Because this is the reality of the corruption and the swamp we live in. Moving on to the charts analysis, starting with the SPY, the S&P 500. Here is a 15 minutes chart. The next level we're eyeing is around the area of 342. Number one, we do have the upper limit of a big breakdown candle that becomes a natural goal when they crawl their way back up. And we also have another gap around that area. 342 is an important goal to reach if we continue building on the gains from the bounce today. If we don't, we do have solid support for now at the level of 339. We're not going to do a daily chart for the SPY. Nothing changed. The reverse head and shoulder formation, the bullish formation, is still intact. So we will move on right away to the Qs. 15 minutes chart. We know that the 274.40 is a solid support. It proven that twice yesterday, and we saw the gap higher right after the support today. Now, where is the next goal and destination for the Qs, assuming we continue building up the gains from the bounce today? Number one, the upper limit of the breakdown candle at around 280.95. Let's make that 281. And of course, right around that area, there is the natural resistance due to a prior gap at around 281.61. So we will watch 281 and how the Qs will react at that point. Here is the daily look for the Qs. Nothing new. The reverse head and shoulder formation, the bullish formation, is still there. You can have a macro outlook, a negative one, and you will see a bear flag formation. So the short-term outlook based on today's activities remain bullish. The long-term outlook remains bearish until, of course, we recapture the trend line. Moving on to the Dixie, the dollar index, and we are doing a 2 hours chart in this one. We are aware about the significance of 93.50. It was support turned resistance and now support again. We didn't visit 93.50 today, but we are forming what is known as a cup and handle formation, which is usually resolved to the upside. So we will put that on the bearish list for stocks. Speaking of the bearish list, let's visit the VIX. The VIX declined today. However, from this daily chart, we can see what is called by technicians as a stick sandwich formation in the VIX. One green candle surrounded by two red candles that happen to reach the same level of support, indicating that the VIX will rip higher from this point on. We will see if the stick sandwich pattern will be reliable this time around or not. But again, we'll take that under the bearish signals for the market overall. Combine the VIX with the cup and handle and the dollar index, and you start to question the bounce today. Moving on to Tesla. Here is a daily chart, and as we can see, Tesla decisively broke the wedge and now is trading comfortably above the upper level of the wedge, so we don't need that anymore. What we will do instead is extend the lower trend line, and that would be the next level to watch in Tesla. Remember that breaking the wedge is a very bullish signal. However, you need to look at different perspectives of the charts, specifically longer term ones. So when we switch to the weekly chart of Tesla, you can see that the MACD is still curling down, trending negative, ready to make a significant cross to the southern destination, creating red impressions in the histogram. So what do you do with this information? One chart telling you that Tesla's bullish, another one, a longer term one, telling you it's bearish. Well, it is exactly that. Tesla is bullish in the short term. It remains bearish in the long term, in the weekly perspective. So Tesla now has the chance for a few days to do some repair in the weekly chart. Tesla needs big days of gains, say tomorrow, Friday, perhaps Monday, and the weekly chart will start trending positively. Will it do that? From my experience, you always trust the weekly chart. The weekly chart is telling you Tesla will have a little bit of good time for now, but overall it will trend lower from here. I'm still holding my November puts on Tesla. And now let's conclude the video. Check out the blue meter next to the charts for the indices right in front of you. We have witnessed very low volume today, and low volume is one of the conditions for a dead cat bounce. A massive bounce right after a big decline that turns out to be a fake out, and the decline continues in the days and weeks thereafter. Low volume isn't the only indicator. The other indicator is what we talked about in the headlines segment. The assumption here is that there is a stimulus deal after all of some sorts. Yet the Democrats right now are winning, and they have zero incentive to pass any stimulus. Furthermore, the airlines, all these other industries have already extended billions of dollars from Treasury loans, and they're just using the bailouts as an excuse to extend employment that they're already intending to lay off anyways. The more you think about stimulus, the more you think that we actually don't need it. You only need a smaller program that extend aid to people who need it the most. And of course, the other point here, we know that Jerome Powell and the Fed spent trillions of dollars greasing up the market to quote unquote make the market functioning. How is that functioning, Jerome, when the market moves up 400 points and down 400 points based on tweets from Trump? And speaking of Trump, of course, it is starting to look a lot like we're going to have a Democratic sweep and Biden will be the next president. You might have heard today from the media that they're saying or attributing the reason behind the rally today due to the market realizing and accepting the fact that Joe Biden will be the next president. So the market is no longer rallying on the tune of Trump. The market doesn't like him anymore. What happens when Trump realizes that the market is rallying hand in hand every time Joe Biden rises in the polls? Perhaps Trump needs to crash the market to tell people, look at what's going on to the stock market every time Joe Biden rises in the polls, and scare people away from voting for the Democrats. But again, don't expect the president to be in a functioning condition right now. I don't know what's going on over there, but it is erratic and it is a chaos all over the place. And we do know that he's not going to go down easy. He's going to go down swinging, causing lots of destruction on the way. And perhaps the stock market here will not be spared as we see the president sinking in the polls. Today, I took advantage of the bounce to add to my shorts and to my puts, because when I combine what's going on in the news flow with the politics plus the technical indicators from the dollar index, from the VIX, I see the correction resuming. And of course, you have to keep your eyes on the chart of the Qs. Breaking the neckline to the downside is your confirmation that the reverse head and shoulder formation is dead, and the market will trend significantly lower from that point. However, rallying closer to the trend line and even recapturing the trend line will be your signal that you need to follow the bullish trend. For whatever reason it is, the market will continue to rally in that scenario until it doesn't.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.